Hi, welcome to the Investment Blueprint. I'm your host, Raghu Kumar from Rain Technologies. The Investment Blueprint is a weekly podcast where you can find me interviewing real-world quantitative traders and investors, hedge fund managers, and industry experts in the field of quantitative, data-driven trading and investing. My goal is simple. I want to help you make more consistent, profitable trading decisions in a data-driven and meaningful manner. Today's topic is on how to do algorithmic trading in India, with a focus on the different types of algorithmic trading strategies. We often tend to generalize trading strategies. If it's not an investing strategy, then it's a trading strategy. How many ways can I slice and dice the universe of trading strategies? Well, it turns out that you can slice and dice them quite a bit. Today, I talked to Lakshmeesh Rao, Chief Investment Officer at Rain. Lakshmeesh joined us a few months ago, along with Bharat Rao, to take over the CIO duties at Rain. Lakshmeesh and Bharat used to run a company called Alpha Matters, where they built and licensed proprietary trading strategies for India's capital markets, the US markets, and all sorts of asset classes in between, including cryptocurrencies and Forex. Lakshmeesh is very diligent and methodical with his backtests, and it's been really fun to kind of get to see how he thinks about solving real world problems in a daily manner. Today, we talk about different types of trading strategies, how they differ, and as a quant, what you should know about them. So, Lakshmeesh, welcome to the podcast.
Thanks a lot, Raghu. It's a pleasure to be here.
Awesome. So, I thought we could start today's conversation by talking about your background with algorithmic trading. How did you get started with this whole field?
I finished my engineering in India in the field of electronics and telecommunication.
Okay.
After that, I had a brief stint with Infosys for a year and a half. And then I went on to do my master's
Mm-hmm.
from the Delft University of Technology in the Netherlands,
Okay.
where I specialized in control systems. So,
Got it.
control systems was a multidisciplinary field wherein you would take any system and abstract it into a mathematical model. And then we used to design algorithms to control them.
Mm-hmm.
So when I was graduating, I also got into this project called iGEM,
Mm-hmm.
which was mostly to do with biology,
Mm-hmm.
where we tried to do some funny stuff with cells.
Okay.
But so there I had a teammate, so he was into machine learning,
Mm-hmm.
and he used to tell me a few things about the markets and all that.
Mm-hmm.
So once I graduated, I had to pick a field wherein I would implement all these learnings, whatever I had done in my masters.
Mm-hmm.
So I thought, like, okay, the market seemed interesting to me at that point of time,
Mm-hmm.
and I just wanted to see, like, okay, where I can go with it. So then
Got
I
it.
approached a bunch of people along with Bharat. So
Mm-hmm.
Bharat was one of the people to respond to me. So
Okay.
then,
Yeah.
so then I got started with Bharat.
Okay.
Yeah. So that began my journey of algorithmic trading from there. Yeah.
Got it. So this is generally your experience in the Netherlands. I think you've told me
Yeah.
once about this, but I totally forgot. Just generally, how was your experience in the Netherlands, and how was it different from your upbringing in India?
It was very different back there. I mean, there you had to be independent all on your own.
Mm-hmm.
Yeah. Here, at least teachers, everyone will follow up with you, but
Right. Right.
there's no
Right.
such
Right.
thing. I
Right.
mean, there it should be purely driven by you, what you want to achieve, your goals, your dreams,
Right.
your
Right. Right.
ambitions.
Right.
Yeah.
Got it.
And
Got
it
it.
was mostly a project based education in a way. So
Got it.
we, yeah, I think that helped me a lot.
Mm-hmm. That's
Yeah.
really cool.
So yeah.
Yeah, and one thing I've noticed is you have very peculiar sleep habits. Everybody at Rain generally works relatively normal hours, and you kind of come out of left field and you stay up until I think like 4 in the morning, and then you start at like 9 in the morning or something, right? So, how did you kind of get into that habit, and is there any reason for that?
I think designing algorithms is more a creative process in a way
Right.
where you would need a lot of peace time. I mean, alone time, where you need to think a bit and try to come up with ideas. I think that entire process happens to me good in the night times, right, where everyone is sleeping and there's no one to disturb me.
That's amazing. I can totally attest to that.
Yeah.
When I used to build algorithms, on a daily basis, I used to also have very odd sleeping hours. I would work at night, like completely in the night, and then I'd go to bed at like 3 or 4 in the morning.
Yes.
And then, yeah, I totally get that. So, today's topic is on the different types of trading strategies, right?
Hmm.
So obviously, we have the general bifurcation of investing and trading, but
Yes.
within trading strategies, I feel like there's oftentimes a generalization that happens and all trading strategies kind of get clubbed together. So I thought we could kind of dive into that today. So, from your perspective, generally speaking, what are the different types of trading strategies that a quant should know about?
Well, according to me, there are primarily two sorts of trading algorithms which you can build.
Hmm.
One which is based off of momentum, which means, let's say something goes up, right? You tend to buy it higher and you tend to sell it even higher, or you tend to short it and then try to buy it back at a lower price, right?
Hmm.
So that's more to do with momentum. There you're saying, like, okay, if something runs up, you will have enough momentum going forward to capture that extra alpha there and still try to make something out of it. Yeah.
Right.
So that's one. And then there is value trading, right? Or mostly mean reversion strategies,
Hmm.
where you're saying once something goes down, it's most likely that it's going to come back to its mean. Similarly, if something goes up, again, you're expecting that will also come back to the mean. So broadly, if I try to define it, or from at least from my experience, these are the main two categories of algorithms which you can come up with.
Got it.
But there are also some other ways of looking at this entire process, like what we do in US, for example, right?
Hmm.
So there we trade volatility based instruments.
Hmm.
There we try to identify some more fundamental factors and then combine it with machine learning. That doesn't fall into these two classes, but there we try to identify somehow the underlying phenomena due to which you can produce returns.
Got it.
So that's another class of algorithms altogether.
Got it. Got it. So basically, the second class that you described is basically like a mean reversion kind of a
Yes,
strategy,
that's
right?
a purely
Yeah.
mean reversion sort of a strategy.
Got it. Interesting. Okay. So, for example, like an arbitrage strategy that would fall,
Yes.
I guess, into the second classification, right?
Again, two ways of doing it. One, you can either look at the pure time series itself,
Hmm.
where you're saying, okay, a time series itself is going to mean revert. For example, SPY in the US. So there we had a mean reverting strategy on the SPY itself.
Hmm.
So there we did not compare it with any other instrument or anything. So there we worked off of purely the time series of SPY itself. So there you say that, okay, if SPY falls X percentage, or depending on some quantitative factors, then we say, okay, it's fallen enough sufficiently down. So now you can buy and expect it to go back up. And similarly, when it goes up sufficiently, then we say, okay, it's got run up. The run up is done. Now it's time to short it.
Got it. Got it.
So that is one based off of the time series itself.
Hmm.
And then you can also look at it in terms of the cross section. Okay, you can
Hmm.
compare SPY with, let's say, Nasdaq or something like that. Or a good example in India would be HDFC and HDFC Bank, for example,
Like a pairs
like a
trading,
pair,
right?
like a
Hmm.
pair trade. Yeah.
Right. Right. Right.
So there you can say, like, okay, HDFC Bank today has gone up X compared to, let's say, HDFC, the
Hmm.
other stock. And then you say, okay, I'm going to short HDFC Bank and I'm going to go long on HDFC, expecting both of them to come back to their relative mean.
Right.
So that is another type of mean reversion. So there you're not looking at the time series of one individual instrument, but you're looking at the time series of multiple instruments.
Got it.
Now the same thing can further be extended into, let's say, a sector level also.
Hmm.
So that's where comes your startup strategies, right?
Hmm.
There you're saying, okay, instead of just comparing two stocks, now I'm going to look at a bunch of stocks in a sector itself, right?
Hmm.
And I'm going to go long on a bunch of on a bunch of stocks in that particular sector relative to their value with respect to the other stocks in the same sector. For example, we might take a look at banking.
Hmm.
So in banking, we might say, okay, like let's say SBI, HDFC Bank, all of them are slightly undervalued today, whereas your ICICI Bank, your Axis Bank are overvalued.
Hmm.
So I'm going to go short on a bunch of stocks there, and I'm going to go long on a bunch of stocks in the same sector. As an extension to that, then we can also look at the entire universe of the stocks itself, right? So there we don't need to limit ourselves to sector. So then we can go on to say, like, we can do something like an index. We can compare it with respect to the index. An index can be something which you come up with on your own,
Hmm.
or it can be the index like a Nifty or something. And then you're going to say, like, okay, Nifty has done this. Some of the stocks have gone have outperformed compared to Nifty.
Hmm.
Some of the stocks have underperformed compared to Nifty.
Got it. Got it. So, for a newcomer to kind of start building strategies of their own, right? What types of trading strategies or what category of strategies would you recommend for a newcomer to kind of get started with, and why?
Okay. To get started with, I would say even before he gets into actually designing a strategy, right? It becomes key for him to understand what he's trying to trade.
Hmm.
Yeah? For example, is he trying to trade Nifty? So then he has to understand what are the characteristics of that instrument. From at least from my general experience, Nifty and Bank Nifty are mostly trending stocks.
Hmm.
So he could start experimenting with something like a simple moving average, and then
Hmm.
go on to more complicated ways of extracting trends, right? For example, then if I go to SPY, if someone wants to trade SPY, so then again he has to understand how SPY behaves. I mean, you cannot go about implementing trend sort of systems on SPY, because you know that it will not work out.
Got it.
All this is related to the time frames, but I'm mostly speaking about a daily time frame here. So then, depending upon the particular characteristic of the instrument, for example, if it's a simple train, it's a simple momentum-based strategy that he wants to try out, they can start off experimenting with a simple moving average and see how it
Hmm.
behaves. And he can also use any of the publicly available indicators. From my experience, most of them don't work. Yeah,
Okay.
but
Yeah.
given his understanding, and if he knows when to exactly trade a certain indicator, I think he can get it to work. Yeah. But I would suggest just start off with a simple moving average and see where it takes you from there.
Got it. Which is probably one of the most common,
Yes.
indicators that people use, right?
Yes.
So, in terms of like just kind of challenges that they would face, right, in
Hmm.
terms of building a momentum strategy, versus a mean reverting strategy, what are some common things you've noticed with either of them? Any sort of biases or anything?
Yes. Okay. That is one thing which, as quants, we always need to take care of,
Mm-hmm.
right? The way we back test it, the data that we back test it on. For example, I mean, it's better if he just splits his data set into two parts where he's going to say, okay, I'm going to test only on a particular data set, and then I'm going
Mm-hmm.
to just leave out the other data set as a test bed, right? Where I'm not going
Right.
to. So let's say I'm going to optimize a bunch of parameters on my training set. I'm not going to go back and then re-optimize those parameters to again fit the test set.
Right.
Yeah, because that is just for your testing to see like, okay, whatever theory you have is valid or not. So once that
Right.
gets invalidated, there's no point for you to trying to optimize it over the entire time frame and then say like, okay, something is working, let me start running it with capital and all that, because more often than not that will lead to problems.
Right.
The other problem is you adding too many rules into one system. It's better if you can keep the system as simple as possible, but come up with multiple systems. Yeah. So that way you're trying to hedge out your risk rather than trying to come up with one super optimized system saying, okay, I'll add a bunch of if then rules and then I'm going to get
Yep.
something working just for the sake of it working. And then you know that most often than not, it's going to fail in the forward test or in your live environment.
Yep. 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 That makes sense. Yeah. So
And
one
also
thing
take
else I
care of,
wanted to,
yeah,
yeah,
if I
sorry,
can
you can
just
keep
add
going.
something.
Yeah. Mm-hmm.
Yeah. Another thing is the data quality which you're dealing with. Yes. That also
Mm-hmm.
makes a lot of difference. For example, one thing we've noticed is the open values, right? I mean, I
Mm-hmm.
can run a simple trend following strategy and say, like, okay, I'm going to take the opening values of any day with assuming the day level data is available to me free of this one. I mean, it's
Right.
available freely in most websites. I mean, you can
Right.
go and download it from Yahoo. But then you know that those numbers are not realizable in your real life.
Right.
That's again another problem which people have to understand, that data matters, the quality of data matters. The quality of data which you're going to backtest on is very important.
Makes sense. So, let's kind of pivot a little bit into something slightly different topic, but still related to the topic of today. So, one of the kind of introductions you and Parth made to Rain is this idea of running multiple strategies in tandem, right?
Yes.
Can you kind of elaborate on this whole concept? Why do you think it works, or why does it work, I should say?
Yes.
And how does one kind of think about that?
Yeah. And so this goes back to my point of like not trying to over optimize something. Yeah. There are only a certain ways you can extract alpha from an instrument. Yeah. And any other way you try, it will
Mm-hmm.
give you something or something thereabouts itself. But then you're better off adding different types of strategy into your portfolio than trying to say, okay, I'm just going to run only a trend following on the same instrument, but I'm just going to change my moving average settings, right? I'm just going to make it from 100 to 50 or 25. Yeah. And this way I'm going to come up with 10 different systems. But then if you can add a mean reversion strategy to just one single trend following strategy, I mean, the amount of diversification benefits that you get will be humongous. Yeah. Just to give you an example from the crypto markets. Yeah. So crypto markets, we know, mostly are trending markets. You know that, okay, once these are mostly called reflexive markets, where you know that, okay, when something shoots up, the trend is going to continue for some time. Yeah. Or instead of just adding one strategy, for example, one of our strategies had like a drawdown of close to like 15% annualized to produce a return of 25% annualized unlevered. And then what I do, I come up with the same trading strategy, but on, let's say, on a different instrument. For example, let's say we take Bitcoin and Ethereum as an example. We run the same strategy on Bitcoin, the same strategy on Ethereum, and then we try to diversify across different time frames, right? You can run strategies at a day level data or at 1 hour, 15 minutes, these sort of things. And then you try to combine different philosophies of reversion also in this. From what we've observed, at a very lower time frame, the crypto markets are mean reverting. Yeah. So what happens? Yes, and then you can also add some intraday strategies. Yeah.
Yeah.
On the same instrument as well, right? So what this does is, eventually we were able to bring down the drawdown from, let's say, 15% to now, let's say, close to 5-6% annualized, but to produce the same sort of returns. Yeah, which would be like, let's assume on a conservative estimate, like somewhere close to 50 to 70% unlevered.
Right.
Yeah. But then you see the beauty of it, right? You're able to produce to 70% with a 5%
Drawdown.
drawdown, yeah,
Right.
as compared to running a single model, which would have suffered 15% to produce similar returns. Yeah,
So technically, if you had a higher threshold for your drawdown, you could even double down on the leverage if there was leverage available, right?
exactly. Yeah, and
Yeah.
then yes, so then that comes to my next point. So what is the advantage of doing this? Yeah, so then you can start levering your instruments up. So let's say you were willing to take the same 15% risk, but now for the same 15% risk, when you know that your drawdown is 5%, you can hit a leverage of 3x, and that automatically boosts your returns up to like what, 200, 210%
Yeah.
odd.
That's amazing. Yeah.
Yeah, so I think that's where the diversity helps. One is you bring down the drawdowns, yeah, which brings down your risk, and it can also help you take leverages, knowing, okay, what you're dealing with. Yeah. For
Right.
example, with a model which has like, let's say, 15% drawdown, there's no way you're going to hit a 2x or even a 3x leverage, because yeah, at one point of time, I mean, the numbers might say anything, but when you're running something live, you know that you'll start panicking and you'll start
Right.
to screw
Yeah.
around with
It has to
systems.
be
And
realistic too. Exactly. Yeah.
yes, yeah, it has to be. Yes, the
Yeah.
numbers are one thing, and then you also have to think about your live trading experience. Yeah?
Exactly. Yeah.
I mean, will you still have confidence in the strategy after something you lost 15% of your capital?
Right.
I mean, it's something you'll have to think about. So that's why what we're trying to do here at Rain right now is to have to come up with, for each portfolio, come up with multiple strategies, so that we are able to cut down on our risk. One thing which we've learned is returns will come if you're able to manage risks properly.
Right.
But once you blow out capital, there's no way you can get back into the game.
Exactly. Yeah. That's the number one rule, right? To
Yes.
not lose money.
To
So
not lose money.
yeah.
Yes. Yes.
It's not to make money; it's to not lose money, right?
Yes. Returns will come. Yeah. If
Yeah.
your models are
Exactly.
good enough,
Right.
and given the market conditions are right, the returns will surely come.
Right.
But you
Yeah.
need to have the holding power, which is what the diversity of strategies will give you.
Right, right. So, obviously you and Bharat have made strategies for other markets as well, not just India's capital markets, cryptocurrencies, Forex, and also the US markets, right? So,
Yes.
when you guys make strategies for the US market specifically, right? US versus India, because obviously different asset classes have different, things going on for
Yes.
them, but specifically for the
Yes.
US and India, how
Yeah.
are the strategies different, when you kind of, your general approach towards the environments? And how are they similar too? Yeah, yeah.
Yes. Yeah. So we don't try to differentiate between whether it's what sort of a market it is.
Okay.
We first try to identify, okay, what is the underlying behavior of any instrument, and then we go about look. For example, Nifty, the index in India, you know that trend following strategies will work there. The same thing will not work in the US over a long term. There we know that, okay, mean reversion strategies, at least for us, has worked very well. Yeah, if you're able to handle the risks that come with it. Then the other aspect in US is that's a more deeper market compared to, let's say, India or your cryptocurrencies. So that's again a challenge which you'll have to deal with. Yeah, you'll have to start looking at probably lower time frames and those sort of things to deal with these issues.
Got it.
For example, a simple strategy which works on even a daily time frame in India, yeah, would most likely not work out in US.
Okay.
Just with the depth of the market and the
Got it.
liquidity that's there in the market. So there, what we do, we try to go at lower time frames and see like, okay, what's the kind of alpha that's available there. Yeah.
Okay, that's interesting. So you're saying something which works for the daily market on OHLC data for India would probably not work in the US, you're saying?
It'll not. For example, one simple strategy I can tell you is the pair trading strategy. I mean, that works very beautifully on the day level data in India. But the same thing will not work in the US. I mean, if you just
got it,
at least from our experience, it hasn't.
Yeah.
So then we try to move to lower time frames and see like, okay, if it's working there or not. And yeah.
Got it. And what about like different asset classes? So you and Bharat have built strategies for crypto as well,
Yes,
which we're looking to launch soon at Rain as well. But just generally, kind of, from a high level perspective, how do cryptos kind of differ from stocks?
Cryptos, I think, are highly volatile compared to stocks.
Right.
But then that's where you can also produce your returns. For example, one simple model which we are running in India, a simple trend strategy, was producing close to, again, like let's say for a drawdown of annualized max drawdown, like 15% volatility. Okay, it used to give us close to 20 to 25% annualized returns. The same strategy for the exact same risks in the crypto markets is giving us close to 80 to 90% annualized.
Wow.
So that's the major difference there.
Right.
But
is that due to lack of competition, or is it because it's a new asset class, or both? Yeah.
It's a new asset class, plus it's not as deep again. Yeah.
Right.
So the moves tend to be large. So that's again where you need to handle your risks. I mean, there also again, I mean, your max drawdown can say anything, but there's nothing stopping Bitcoin from like going down 30% in a day, just like that.
Right. Yeah. So I think we have to have a different conversation on just crypto. I'm realizing this on the spot, so we'll definitely do that. And so kind of looking at the behavior of a typical quant, right? Especially someone who's kind of starting out, building their own strategies for the first time. What are some common mistakes quants make when they're backtesting and building strategies?
Okay, some of the common mistake I would say are biases which you introduce, like some sort of look ahead bias, right? I mean, that okay, you shouldn't be taking the close data of that day, for example, but you'll still make a mistake of saying like, okay, just the data points that you take, you'll have to be careful that I just do whatever I'm doing on data which I know that okay, it's not in the future. Yeah.
Right.
So that is one point which you need to avoid. And then again, you'll also have to take care of the way you implement your stop losses and all that, so that you know that okay, most of the times your stop losses are not going to get realized.
Right.
Just because of the gaps and all that.
Right.
So that you'll have to be very careful of.
Right.
And also you'll need to think about okay, just the inherent biases which exist. And let's say I'm trying to do a startup strategy on the universe of stocks in Nifty today. Yeah. But before today, also there were other stocks also in the Nifty, which have gotten taken out for various other reasons.
Right, survivorship bias.
Survivorship bias, exactly.
Yeah.
So that is again which you need to consider. Like, okay, something has worked, but I also need to know that okay, what hasn't worked.
Right.
And I also need to go and analyze like, okay, why it hasn't worked, and tomorrow if such a situation occurs, how am I going to handle it? Yeah?
Right. Especially when the bias, is implicit, right? So, for example, if you're talking about a strategy where you're building, a portfolio of stocks which are performing well, right?
Exactly.
And then you have survivorship bias with an index, right? That can make a huge difference because those two things are correlated, right? But maybe in a stat arb situation, maybe not so much, but still, I would say it's something you should look out for, right? Yeah.
Yes. Yeah. You always have to. Yes.
Yeah. 100%.
That becomes even more relevant in terms of pair trading and all those things.
Right.
And you also need to know, more importantly, like when your strategies will not work, right?
Right.
More than when your strategies are working, you also need to understand, okay, when can the strategy fail? For example, a momentum or a trend following sort of a strategy
Mm-hmm.
will fail if there are no trends in the markets. The market
Mm-hmm.
can go flat for quite a long time. A classic
Right.
example would be 2017 in India,
Right.
or 2018 in the crypto markets, when, let's say, the Bitcoin didn't move at all. Yeah.
Mm-hmm.
So there you're going to get whipped a lot. Yes.
Mm.
So then you'll need to consider those things and say, like, okay, these are the situations wherein this strategy will fail.
Right.
And that is where, again, I would say, like, so instead of running one thing, you tend to diversify yourself at a strategy level, at a time frame level as well. Because I mean,
Right.
there might not be momentum, let's say, at the 1 day level, but there might be momentum at some lower time frames. So if you
Mm-hmm.
can trade
Mm-hmm.
that as well along with your existing, that'll also help you cut your losses during the bad times.
Right. 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 Yeah, and basically covering all the different market regimes, right? I think.
Yes. Yeah.
Yeah.
So yeah, I would say, as a beginner, you would need to consider all these things.
Mm-hmm.
So more importantly, as to why a strategy is working, yeah, if a strategy is working, you would also need to make an analysis as to, like, why it's working. Also,
Right.
I mean, it just can't be just purely numbers. Yes.
Right. Right.
Yeah, that understanding has to be there as to why something would work, why something would not work,
Makes sense. Yeah.
so
It's
that
a
when the
never ending
conditions
process. Yeah.
it is a never-ending process. Yeah,
Yeah.
I mean,
Yeah.
it's
No,
it's
that's
an
a beautiful
ongoing
thing, right?
process.
Because the markets are evolving, right? So even
They
anything
are,
you think
yeah,
is true today, might not
yes,
hold true. So these concepts probably matter more than, any
yes,
sort
yeah,
of concrete, strategies or anything, right?
yes, yeah.
Cool, Lakshmi. So last question for today, I mean, if you had to give some advice to any quants
Hmm.
listening to this who are building strategies for the first time, because we do have many of those guys listening to this, what
Yeah.
like what would be your advice?
Apart from the things that I've said,
Yeah.
one thing I would like to say is, if it's your money that you're trading, you're still okay. Yeah, because it's your personal money. But
Right.
at least at an organizational level, we know that people's monies are involved. I mean, they're hard-earned money.
Right.
So we cannot be reckless with our strategies, right? I mean, we cannot choose strategies which you know are going to undergo huge volatility, right? And you
Mm-hmm.
cannot take unnecessary risks. I mean, you can't take high leverages. Yeah.
Right.
So you need to be careful in your risk management when you're dealing with at least an organization, yeah,
Right.
and when you're dealing with public's money, basically.
Right.
So you need to understand that, okay, I'm dealing with someone else's money, so let me ensure that I'm as safe as possible with others' money, yeah, and
Yeah.
design my strategies accordingly.
Makes sense. All right, man. Well, thank you so much. That was a really engaging conversation, and I'm sure we'll have many, many more. Well, I mean, we have ours all the time, but and I'm sure we'll have another one of the podcasts as well.
Yeah, thanks a
All
lot,
right.
Raghu.
Yeah.
Yeah, it was
Cheers.
a
Yeah.
pleasure speaking to you. Yeah, cheers, bye.